and welcome to Badger Talks Live, which brings exciting happenings, resources, and talent from your UW flagship campus to the people of Wisconsin and beyond. I'm Olivia Ray. I'm a student studying personal finance in the UW School of Human Ecology. I'm originally from Minnetonka, Minnesota. It is my pleasure to introduce UW teaching faculty member and certified financial planner, Linda Lepe. Today, Linda will be talking about the basics of investing. Among other things, she'll cover the differences between stocks and bonds and let us know if mutual funds are good investments. Her talk seems to demystify investing and help motivate people to save for their future, regardless of age. Linda was involved in the creation of the Badger Sense program, which provides credit courses about financial education to undergraduate students, along with workshops and resources. Currently, she is developing a financial coaching program for personal finance students where they receive instruction and real-world experience working with others. Please welcome Linda Lepe.
Hello, welcome. So happy to be here today. Well, investments. It's a big topic, and we're just going to touch lightly upon some of the information to get you started, to get your head wrapped around this particular topic. And I call it Investments 101, just because we're going to touch on some things, and toward the end, I'm going to give you some resources. So let's get started. Maybe not. There we go. All right. So what I'm going to do is define different investment categories so that you have an idea, a starting point. Then we're going to talk about managing risk. The one thing that's really important when we deal with investments is not just to jump in, but to think about how do we feel about risk, and how can we be smart about setting up an investment plan. And then I'm going to throw in at the end a few other things for you to consider. So let's get straight with what the definition of investments are. People get involved with investments because they want to generate returns. And there's a few different ways on how you do get returns. One is maybe your investments provide you with income. Maybe they provide you with interest, which is a type of income, or maybe they provide you with appreciation, meaning that you buy something, it goes up in value, and then you have the opportunity to sell it. Sometimes there are investments that do all of these things. And so as I talk about some of these different categories, I think you'll get a better feel for what different things investments do. It's often times where people think about, I am to an investment because I want it to go up in value, but that's not the only thing that an investment can do. So the major categories we're going to talk about are stocks and bonds. I'm not going to touch on cash or cash equivalents. This is savings account, checking account, CDs, that type of thing. So the focus will be today more on stocks and bonds. So let's start with bonds. These are considered lending investments, meaning that you are going to lend money to some entity like a government or a corporation, or even a bank. And in return, you're going to get interest. So in the banking world, money in your savings account is earning interest. And right now it's not earning much interest, to be sure, but you are getting some interest from it. And that is a type of income. Also, we can get bonds. And what bonds, we'll talk more about what bonds do, but where bonds are provided or needed is usually at the federal level, at the municipal level, which means state and local, or corporations are going to issue bonds. The nice thing about bonds is that you're paid on a regular basis. It may be quarterly, it may be semi-annually or annually. But with bonds, there is this predictable income coming to you. And it's that predictability that is why people like bonds. When I said savings accounts are a type of investment, yes, they are. They're earning almost next to nothing these days, but we do put savings accounts into the lending investment category. So how it works with bonds is that you are providing money to an entity, and let's think in terms of $1,000 increments. So let's say the example I always like to use in class is, let's say there's Coca-Cola wants to build some overseas operations, and they need to raise money to do this. And so they're going to do that via bonds. What that means to you as a consumer is that perhaps you can get a $1,000 bond from Coca-Cola that pays 5% interest. And for the next 10 years, you're going to get that interest on a regular basis. And at the end of 10 years, the bond is going to expire and you get the $1,000 back. That's basically how bonds work. I use Coca-Cola as an example. It could be the federal government. It could be, the state of Wisconsin. The Fluno Center here on campus was built with bonds, same with Miller Park. So it's when an entity needs temporary funds, and then they pay you back on the back end. The main advantage to bonds is their predictability. So we got a couple of things going on here. One, you're getting that interest on a regular basis. You know in advance, for as long as you own that bond, when that bond's going to pay out. So in my Coca-Cola bond example, you're going to get paid 6 months apart in a certain month. And you know that for the entire time that you have that bond. The other thing that's predictable is at the end, when the bond matures, you are going to get that $1,000 investment back. So a lot of predictability with bonds, which, as you can imagine, make them a bit of a safer investment. With this safety, however, comes low growth rates. In my Coca-Cola example, I use 5%. That's probably high for what a corporate bond would pay right now. But let's say it's something like 3 to 5%. Anytime with an investment where you have a lot of safety built into that investment, the growth rate is going to be low. So think about savings accounts, a lot of predictability, that money's there when you need it, it's liquid, very low interest rate. Bonds, a little bit higher growth rate, but predictable nonetheless. One of the things that has come up in class, which I find interesting to answer, is what's normal interest rates? Because I have been saying now for years that we are in an abnormally low interest rate environment, and we are. And so this is looking back over the history of the United States, where interest rates have been. And if you look in the 1980s, you can see how high they were. And this is when I graduated from college and bought my first car, and I had student loans, and look at how high the interest rates were then. And I thought that was normal at that particular time. Now we've been sliding downward, and since 2008, interest rates have been very low, and that's not particularly normal either. So when students ask, well, if these are really low interest rates, what's normal? Normal is somewhere between where I was in the 1980s and where we are today. So it's a bit higher than where we currently are, but not this double-digit interest rate environment. So let's move on now to stocks. You are going to become an owner when you buy stocks. And I will throw in the other category of real estate, not your primary residence, but like commercial real estate, or maybe buying apartment rentals, something along that line. In either case, what you're doing here is you are participating in the success or failure of that business. So if you own Apple stock, you want to see that stock do well. You want to see that company do well, because then you'll get to experience the success in part by seeing the price of that stock go up over time. Real estate works in a similar fashion. You want to see, the value of that real estate go up over time. And one of the nice things with real estate is that you also get income from it. Some stocks will provide income via dividends, but not all stocks do. So if dividends are important to you, that's something that you can research ahead of time. But here's the thing with stocks, they're less predictable. We talked so much about, before with bonds, about how their predictability. You kind of know when you're getting your interest rate payments, you know when it's good, when the bond's going to expire. With stocks, there's less predictability, but there's more upside potential. And that's the trade-off. And so with this more growth, that means that we are taking on more risk. And by taking on more risk and taking an ownership stake in something like a company, that has its pros and cons. And the idea is over time, you can see that appreciation, you can see that upward trend. But the trend isn't always a straight line. And this is showing the markets from before the Great Depression to through last year. And if you take a look at the top line, this is small company stocks, and you see that trend, but then you see the bumps along the way. And perhaps you see the dip at 2008. You'll see a little bit of a dip there from when the pandemic started. That was a very short dip, but the trend has been upward. The next blue line down, that's kind of that gray blue line, is large company stocks, which also have had that strong upward trend. In orange, those are government bonds, and in green are short-term government bonds. And then that gray box that you see below, that gray area, is inflation. And so part of the reason why we think about stocks for particularly long-term needs is to stay ahead of inflation and have appreciation on top of that. Because one of the things that happens with money is that $1 10 years from now is not going to buy as much as $1 will today. And so as you look at investing for your future, part of what you're trying to do is at least stay ahead of inflation, and at most to try to have your money work for you to meet that inflation line and go beyond that. So stock categories, you may think about, how do I wrap my mind around stocks? And I like to think about stocks. There's lots of ways to slice and dice the stock market, but one way to look at it is to think about the stock market as falling into sectors of the economy. And these, in general, people think of the stock market in 11 categories, and these are those categories. So if you take Madison Gas and Electric, that would be an energy company. Financials, of course, are banks. If you think about consumer staples, I think a Procter and Gamble, would be there. Consumer discretionary, chose a car, refrigerators, things that you maybe don't get all the time or that you could put off that purchase. And so if we think about the world of stocks in these categories, it starts to make it a little bit easier to wrap your mind around it. Certain sectors are faster growing than others. And depending on how you feel about risk may depend on whether you want to focus on certain sectors. Oh, I said MG&G was energy. I'm sorry, MG&E is utilities, which is not a fast growing sector of the economy, but they pay out nice dividends. So one way to think about this, about the world of stocks, is in these sectors. Another way to think about stocks is based on the size of the company. And we call this market capitalization. But what it means is, what is the market value of that company? So a company like Apple, a company like Procter and Gamble, again, some of those big companies are what we call large cap. Maybe you've heard that term. Large cap companies are just what they sound like. They are companies that are large. A lot of them may be common household names, which, and if they've been around for a while, like a Walmart, like Boeing, those are considered blue chip companies. Not all most blue chips are large cap, but not all large caps are blue chips, because you have some newer companies on the scene, and a lot of the technology companies fall in that area. Then we get into medium-sized companies, which are called mid caps. And then last, we get into small cap companies. Small cap companies and mid cap companies tend to grow at a faster rate than large cap companies do. However, you're taking on more risk with those smaller companies because they don't have the long track record that you would have in a large cap situation. So as investors think about how they want to invest their money, one thing to look at is, are there certain sectors of the economy maybe that you want to focus on? Are there certain size of companies that you focus on? Do you want to focus on companies that have been around for a long time, or are you willing to take a chance on smaller companies because the growth potential is higher? So with stocks, you can gain a lot or you can lose it all. And while it doesn't happen every day, there are stocks that go bust. Here are a couple of them. I invested in a stock back in the late 90s called WorldCom. And WorldCom was in the communications area, and WorldCom went bankrupt, and that stock no longer exists. Fortunately, I didn't own a lot of WorldCom, but it was kind of an important lesson for me on how not all the stocks that we may choose to own are going to be winners. So as we're looking at investments, one of the questions is, all right, if there are risks with investments, how do I manage that risk over time? And this is probably the most important thing that you can do. In fact, it is the most important thing that you can do when it comes to investing. And a lot of people, maybe as they think about investing, get a little queasy or think about, oh, what if I make a bad pick? Well, some of the things I'm going to talk about here in this next section get into managing risk, because my thinking is, if you're going to invest in the market, how can I do it in the safest way possible? You're not going to have complete safety like you would in a savings account, but you're trying to set yourself up for that long-term growth. And as a result of that, there must be some things I can do to help manage my risk over time. So let's dig into this a little bit. The first question to ask is, what does risk mean to you? And there are some nice risk tolerance surveys that exist. And if you go out online and search for investment risk tolerance surveys, you will get some. Some may be as short as a few questions, some may be 10 to 20 questions. But the idea, what comes back is, are you an aggressive investor, moderately aggressive, moderate, moderately conservative, or conservative? And based on that, that will help guide you toward the types of investments that are a good fit. So what does risk mean to you? One of the questions that these surveys will ask is, are you willing to give up money to make gains or possibly lose it? And so when you're putting money into investments, you're taking it out of the safety of a savings account and you're trying to put it to work for you. But how far do you want to go on the risk spectrum so that you can sleep at night? So the opportunity cost of what you're giving up, like I just said, but then the probability that your investments can go down in value. We have been pretty lucky here in the last 10 years or so that we have seen mostly an upward market. We saw a blip. Fortunately, it was just a blip in 2020 when the pandemic started, where the stock market took a nosedive. But then it very quickly, it was like a hairpin turn. Very quickly, it started to go up again. 2008 was an example of a severe down market. They called it the Great Recession for a reason. And the time there, if you were an investor at that time, how did you feel to see your balances go down? If it was, really, really difficult for you, or if you felt like it really went down a lot, then maybe you need to reevaluate how you feel about risk. There are those that say in a down market that that's a great buying opportunity. But what human behavior has taught us is that sometimes when something scary happens, like a down market, the last thing you're thinking about is buying more stock. And in fact, what people tend to do is sell. And that's the worst time to sell. So as we look at markets going up and down over time, how do you feel about those fluctuations? Remember, with stocks, there isn't a guarantee that you're going to make money. However, as you saw with those charts I showed, that over time, the trend is certainly upward. So how do you manage risk? When I talk about managing risk, what does that mean? So the first thing is, how do you generally feel about risk? The next thing is, what are a couple of the strategies that you can use to manage risk? And we're going to talk about two of them. We're going to talk about the power of long-term investing, and we're going to talk about asset allocation and diversification. With long-term investing, I'm going to make a case for why you have to have a longer time frame to consider, especially stock investing. So this is showing different types of assets and how they fluctuate. And starting on the left side with the dark blue, these are small company stocks. If you decided, I'm going to own a small company stock for only 1 year, you may be up 150%, or you may be down 60% in a 1 year period. So a 1 year period is way too short for stock investing, because who knows, where in 1 year you could be down 60%. If you decide to hold your investments for 5 years, you can see that the downside is cut in half. So the upside is also less, but it's still significant. My goodness, it's like 45% in this example, and your downside is just shy of 30%. If you hold an investment for 20 years, now you see that we are not on the downside, we're above zero. And this also gives us an indication of what the return is over the long term. And so as I'm making the case here for long-term investing, keep in mind that the length of time that you're in the market reduces your downside risk and significantly. And if you're in long enough, tends to reduce your downside risk almost completely. But that means that you need to be patient. That if you're only invested for a few years, that's not really a trend. Think about people in 2008 and how they felt. And if you stayed in until 2011 and 12, things got a lot better. That was a hard time. And that's certainly, part of it. But if your time frame is long, then it makes sense to stay in the market. Just working our way through this chart a little bit more. So you see small company stocks. Then there is also the light blue, which is large company stocks. And here you see the fluctuation is less. And then we move over into government bonds, and the fluctuation there is even less. And then we get into these very short-term government bonds. And you could see, well, first of all, they don't go below zero. And second, the volatility is less. So when you're thinking about investing, particularly with stocks, you got to think about volatility and how you're going to handle volatility. And this is as I get back to, what can you do to reduce your risk? I would say have a long-term time frame. That's number one. Number two is asset allocation and diversification. You've heard the old adage, you don't want to put all your eggs in one basket. Well, that's certainly true with stocks in particular. You don't want to put all of your hopes and dreams into one stock, because who knows what that company is going to do, even if you are a long-term investor. Unfortunately, as I found out, companies go out of business. So we reduce risk by not only having diversification within the world of stocks, but within the diversification of maybe stocks to bonds. And now we're getting into asset allocation, or that pie chart that you see. The thinking is with asset allocation and diversification is that you're canceling out. You're canceling out like bad stocks. You're canceling out bad performance. An example is, let's say that you have a portfolio that's 50% stocks and 50% bonds. The stock side is going to grow more than the bond side. But when the market gets bad, the bond side is going to hold up better than the stock side. And so you have a cushion built in. And so when we talk about asset allocation, what we're thinking of here is how to help you weather the ups and downs of the markets. And if bonds aren't as fast growing, they're not as fast losing either. And so bonds, I think of bonds as the cushion in the portfolio. If you're a more aggressive investor, maybe you don't want much in the way of bonds and you do a job, you work toward diversifying your stocks. Over time, what we want to see is for you to do the best you can with the upside and try to minimize the downside. And to provide an example of that and to make the case for diversification, this is called a quilt chart. Quilt, like a sewing quilt. And let's just take a color. If you look at the far right side, under 10 years, those are large caps. So it's that light orange. If we look at the light orange color and just go over time, you can see how some years it's at the top and some years it's further down. Now let's look at the yellow. Yellow is EM, which is emerging markets. In 2017, that was the best asset category. And then the very next year, it was the worst. And so if I'm investing in emerging markets, which is, perhaps, which are countries that don't have as well developed economies as maybe the United States does, but are certainly seeing high growth potential, you may want, depending on how you feel about risk, you may want to invest in something like that. But keep in mind, it could be the best thing one year and the worst thing the next year. And I love showing this slide to show why we talk about asset allocation and why we talk about diversification, because we never know from year to year what the best investments are going to be. Another thing with asset allocation, if you look across the bottom, that's showing the amount of risk. We're quantitating risk there. And if you go to the far right, you can see 100%, a portfolio that's 100% stocks is taking on the most risk in this particular situation. And if you look going up and down on the left side, you can see the return that you're getting. As we start to back down a little bit, if you put some more bonds in the portfolio, you've reduced your risk quite a bit and your return by a little bit. And we can go all the way to 100% bonds, which is the orange circle, which is much, much more conservative than 100% stocks. And you may be asking, well, why do we see that hairpin turn there? And actually, it is true, even if you're a conservative investor, that having some stocks does create another level of diversification and allows you to have less risk and a little more return. And think of it this way, bonds is a very broad asset category, and so are stocks. And it makes sense that by putting some stocks in there, that you're creating a little bit more diversification. But as we financial planners take a look at how you feel about risk, we're also thinking about, okay, from an investment standpoint, based on how you feel about risk, what is the ratio of stocks to bonds? And another way of looking at it is to think about, okay, if I have a certain ratio of stocks to bonds, what was the worst year and how many bad years were there? And so here are some examples. If you are invested 80% in stocks and 20% in bonds, your worst annual loss was 25%. But then take a look at the years with a loss. Out of 61 years, 13 years were down years. So you had more up years than down years. And your average annual return is 11.36%. Also keep in mind, as you look at this, that 2008 was part of this time frame too, and that the worst year for this portfolio was 1980. And then as you start to take on more bonds, you'll see that the worst annual loss goes down, but you'll also see that the average annual return goes down too. So it's a matter of finding that balance for you. The other thing that I find heartening is the years with a loss. Take a look at how there are more up years than down years. And so staying in, your time staying in is very important. So we've talked about stocks and bonds. Next, I want to talk a little bit about mutual funds, because to be honest, this is how most of us are going to become investors. I am not, I worked I started my career in what's called a wirehouse, and there was a lot of people, we were doing a lot of investment recommendations, and I never felt comfortable recommending individual stocks. But I did feel comfortable recommending portfolios. And what a mutual fund is a type of portfolio. And so if you are thinking about investing and going, you know what, I don't want to have to research or pick individual investments, great. That's what the mutual fund world is. What you're picking there is a style of investments, or maybe what's inside those mutual funds. So what mutual funds are a basket of investments, and what's in that basket is determined by the portfolio manager, and they're working toward a certain goal. They have a certain goal that they're working toward, such as, of course, capital appreciation. We want to see it go up, but what are their means of doing that? Or maybe they want to balance out risk over time. So what happens is you put money toward a mutual fund, and you with a lot of other investors. And then that portfolio manager has the ability to buy investments that fit with the goals and objectives of that particular fund. What's nice about mutual funds is that there are a lot of different investments in the funds, and so you do get a certain level of diversification. The other thing, be it good or bad, is there are thousands and thousands of mutual funds to choose from. There is a lot of overlap. You think about, I want to invest in technology. Well, there's a lot of technology funds out there. And so in a little bit, I'll share about how to do some research on that. But what mutual funds are trying to do, and usually it's a low cost of entry too, but what mutual funds are trying to do is help to provide for you some asset allocation and some diversification. This is just one fund, the Growth Fund of America. And if you look at this, you can see the investments that are in there and what percent of the portfolio. This isn't all of the investments in there, but it gives you an idea of what this fund is investing in. And one of the things I look at right off the bat, it's called the Growth Fund of America. And I see a fair amount of what's considered technology in there. And I go, okay, that makes sense, because the tech sector is certainly where a lot of growth is occurring. There are also funds that are set up to achieve asset allocation. And so this is the Vanguard Balanced Index Fund. And what this fund strives to do is pretty much a 60-40 split between stocks and bonds. And so if you don't want to have to do the asset allocation yourself, you can own a mutual fund that could do it for you. So a couple of different examples there. So I want to talk a little bit about ETFs for a moment, because it's another type of fund. Mutual funds, one way to know it's a mutual fund, if you look at their ticker symbol, it's got 5 letters and it ends in an X. Those are mutual funds. ETFs are similar in that it is a basket of investments, but this basket doesn't change much in its composition. Also, it can be traded similar to a stock. Mutual funds are priced out once a day at the end of the day. So if I'm looking at a mutual fund today, I'm seeing yesterday's value. And then at the end of today, after the markets close, I'll get the value for today. With ETFs, I can see in real time what that basket of investments is performing. The key thing with ETFs is that there is not a lot of change to the investment lineup. And oftentimes ETFs will focus on an index like the S&P 500. In this visual here, you can see that there are ETFs that focus on a lot of different things. Sector, you can say, okay, telecommunications or web-based funds. There's lots of ways to slice and dice ETFs, but you're not going to see a lot of change. And people tend to like that. That's a form of passive investing. And what passive investing means is that the basket of investments tends to stay the way it is. The S&P 500 does not change very often, as does other indexes. So that's good from a tax standpoint. It's good from knowing what you're getting standpoint. And I'm not here to debate whether you want a portfolio manager that's making buy and sell decisions that go in that basket of investments, or whether passive investing is better. But there has been this trend in recent years where people have been gravitating toward passive investing for all the reasons I just stated. Another type of mutual fund I want to make you aware of is called target date funds. These funds are only found in retirement accounts, whether they're IRAs or retirement account through your employer. It's an asset allocation fund that shifts over time, and it shifts more conservative as you get closer to retirement. And so what you see in this visual is what we call a glide path. And as you get closer to retirement, you can see the red is stocks. You can see that there is less red and more blue, which are the what would be considered inflation protected or safer investments. And so I love target date funds, particularly for young people that are just getting started out with a retirement account, and they go, how should I invest this? I go, look at a target date fund. So you get that instant asset allocation and diversification. And then in time, if you want to look more at different types of investments, or you want to mix it up more, you can do that. But at least you're getting started with something that has growth potential, but also has some risk management built in. And I just want to take a moment to talk about cryptos, because it seems like this is what everyone talks about. The Super Bowl, I wasn't paying attention at that moment, and I see these bouncing QR codes on my TV screen, and I thought, what happened to my television? And what it was an ad for cryptos. So cryptocurrency, at a high level, it's a decentralized type of currency. So right now, currencies are based by country. So in the United States, we have the dollar. The European Union has the euro. And currencies are different based on the governments that are backing them up. And for maybe governments that are less stable, cryptocurrency may make sense, because you don't know if the money that that you can get through the country that you're in, whether the stability of that currency is going to be great or not. And so cryptocurrencies make sense. Perhaps maybe we're headed to a world where we are going to have decentralized money, and it's not going to be country by country. But for now, we don't know. And so what cryptocurrencies are is this decentralized form of currency that exists. However, it's highly speculative. I know there's people say it's not brand new, but it has come onto the scene in recent years that people are talking about it. It's a much newer type of investment category than, say, stocks and bonds are. And so it's because it is so new and speculative, means that the fluctuations are wild right now. And for nervous investors or new investors, I don't know, Do you want to dip your toes into this at the moment? I also think, this is just my belief, I think some type of regulations are going to be coming, because anytime you start to see people losing a lot of money or maybe seeing some shady dealings going on, that sets things up for some type of regulation, however that happens. So I just wanted to explain cryptos for a moment if you didn't understand what they were. And now you know about as much as I do about it, but I like to bring it up because it is a topic that everyone seems to be talking about as it relates to investments. Just a couple other things here. So you're thinking, okay, this investment stuff sounds great. Questions before you start. What's your goal for this investment money? What's your time frame? If it's short, then you're not going to want to get into stocks, certainly not. And then how do you feel about risk? Once you can answer those questions, then you can start thinking about, okay, how do I want to enter the world of investing? And there are lots of ways to enter it. There are big platforms like E-Trade and Charles Schwab. There's even apps now where you can start with small dollars and start investing that way. The best way to learn about investing is to get some knowledge as you get started, and then to dip your toes in. And you're going to start to learn more as you go. You're not going to learn everything you need to know before you start. So I see sometimes people hesitate, and I would say, get started with something, start with a small dollar amount. Where to find investment information? These are just some suggestions for you. Investopedia is more of a resource about terminology and concepts. They're excellent. Morningstar is a website that on the consumer side does a good job of providing information on financial planning and consumer behavior. Also, you can look up investments, particularly mutual funds. Morningstar made their bread and butter at first on mutual fund analysis. So there is good information out there. It's a matter of knowing where to go. Okay. With that, that was so fast. We teach a class for an entire semester on investments, and you got this all in about 35, 40 minutes. So thank you for kind of bearing with me here. I just wanted to give you an overview, introduce you to some of the terminology, and at least get you to start thinking about how do you feel about investments instead of going for what everyone else thinks is a good investment. What works for you, and how can you best manage your risk to have so that you're not going to be riding the bumps as much.
Great. Thanks so much for all of that wonderful information and for consolidating it in such a nice way. I think it was all very easy to understand and a nice recap for everybody who has, and we certainly have questions in the chat. So hello, everybody. Fran Paleo, Moyer Badger Talks producer. We're talking with Linda Lepe on Investing 101. Feel free to continue to post your questions in the chat. And Linda, I'll start relaying some questions here. So sure. Rob Harris asks, what is meant by blue chip? You did toss that out there. What does that mean?
Blue chip. Blue chip is those quintessential American stocks that have been around for a long time. Recognizable names. Right now, the world of blue chips, Home Depot, Walmart, Procter & Gamble, Coca-Cola, some of the things that I've brought up. The one thing that blue chips do is they share their profits with the people who own the stock via dividends. And so these companies will pay dividends out 4 times a year. And that is another way to get a return on your investment. So of course you want to see your stock go up in value, but if they're also paying you dividends, that's great too. One other thing about blue chips is they're not as fast growing as maybe they once were, but they're kind of steady. They're steady, somewhat reliable companies that everyone's heard of that have a long track record.
Okay, great. Thanks for that. Pat Hulquist asks, what is a good investment mix for saving for college for a preschooler? I've been putting money into an EdVest account for my 4-year-old grandson for about 3 years now. The money is in the account. The money in the account is slightly less than what I've put in.
So something like EdVest, which is an account that where you can save money and invest that money for the child, you are most likely getting some stocks and bonds in that account. And the investments that are underlying it, it would be worth taking a look to see what they are. The fact that it's down doesn't surprise me because in the last 6 months or so, we've seen a very volatile market, and that has probably been down more than it's been up. And so over the long term, if this is for a young person and you're thinking, oh, I'm 15 to 17 years away from needing this money, think about the upward trend. So there's going to be bumps along the way. And that makes sense. But in the short term, yeah, it's kind of a bummer to see your investment down. But if they're young, that makes me feel good because there's time to see that investment grow.
Great, thank you. Luisa Gerasimo asks, also kind of along the same line, I work with teens. How old does a person have to be to purchase stocks or bonds? Is there an age limit?
There is no age limit. When a child is a minor, there may be some considerations on how the account is set up. If someone who's 16 years old goes out and tries to set up an investment account, they usually ask about age. I don't know how easy it would be for someone who's a minor without some type of parental control over it. Though getting started young is fantastic, because I have told this story a lot. I did nothing until my 30s with investing. And as a result, I'm losing out on hundreds of thousands of dollars. So small things early add up to big things down the road. So kudos for encouraging teenagers to start thinking about their future.
Good advice, thank you. Rob Harris also asks, what's a treasury bill?
A treasury bill is, so the US federal government issues bonds, and they are sometimes, well, they come in three categories. The longer term ones are called treasury bonds. It's the intermediate ones, like the 2 to 10 years, are called treasury bills. And then there's the short-term ones. So it's just nomenclature based on how long it is, how long the bond is in existence.
Okay, thank you for that. One last question. Juan Camilo David Gomez says, great talk. Quick question. What's your recommendation to invest in the US market for people in other countries?
I think the best way to invest in the US market, particularly if you're from another country, is to look at something like the S&P 500. And as I mentioned, there's mutual funds and index funds that do this. It gives you a broad exposure to the US economy. There's those 11 sectors that I talked about. At the S&P 500, an S&P 500 index fund would give you exposure to all of those sectors. Yes, they're focused on large companies, so you're not getting those medium and small companies. But I think if you want a good representation of the US economy, something like that would do the trick.
Excellent. Well, Linda Lepe, thanks so much for talking with us today and sharing your expertise with all of us. We all feel a little bit more informed as we start making our investments. Thank you very much.
Thank you.
So please join us next Tuesday. Badger Talks Live will continue February 22nd. We're going to have it at a special time at 3 p.m. Central Time. And we're going to be welcoming UW Extension Specialist Jeremy Solin, who's going to be talking with us about the maple syrup industry. He's a maple syrup specialist. So bring those buttered pancakes along. And please visit badgertalks.wis.edu. You can see our current podcast where Ben Rush talks with Linda a little bit about some of her upcoming talk. See the schedule of upcoming live talks. You can sign up for our email list so you don't miss any of the information about the free events coming up. Consider a donation to Badger Talks. We are grant funded. And you can also search a roster of over 400 UW faculty and staff who've signed up to give talks all over the state. So thanks for tuning in, and we'll look forward to seeing you next week.